Welcome to this explainer. We're jumping straight into the absolute lifeblood of business survival, managing the money. We hear about massive revenues and huge profit margins all the time, but the reality of keeping a business alive day to day comes down to something much more foundational. We're going to break down exactly how cash flows through a business and how predicting that flow can literally mean the difference between thriving and closing your doors for good.
Okay, let's dive into this. How can a highly profitable business go completely bankrupt? It sounds like a total paradox, doesn't it? But honestly, it happens all the time. A company is booming, sales are through the roof, the profit margins look fantastic on paper, and yet they're suddenly forced into liquidation. How is that mathematically possible? Well, it all comes down to a very specific, very dangerous misunderstanding.
To unravel this mystery, here's our roadmap for today's explainer. We'll start with the profit illusion, then break down the anatomy of cash flow. From there, we'll hit forecasting the future and solving cash shortages. Finally, we'll look at working capital and apply the whole shebang to our sunny days case study.
Right, kicking things off with Section 1, the profit illusion. Why profit definitely does not equal success.
Listen, confusing profit with cash is absolutely the most common trap business students and even seasoned entrepreneurs fall into. Profit is just a calculation, revenue minus total costs. It's a surplus on paper. Cash flow, on the other hand, that's your cash inflows minus your cash outflows. It's the physical, actual movement of money in and out of your bank account. Cash is liquid. You can spend it right now. Profit? You can't pay your electric bill with a profit margin. If you don't have the liquid cash, production stops, workers leave, and your creditors can force you right into bankruptcy.
So how exactly do profitable businesses run out of this essential cash? There are three major traps. First, overtrading. If you expand way too fast and buy massive amounts of inventory, your cash gets tied up in a warehouse. Second, offering too much credit. You might make a massive sale today and record the revenue, giving you a sweet profit on paper, but if the customer has 3 months to pay you, no actual cash enters your bank for months. Finally, buying too many fixed assets. Dropping all your cash on a new building or heavy machinery up front drains your bank account instantly, leaving you with nothing for day-to-day expenses.
Let's make this super concrete with a classic example from the source material, Good Hope Enterprises. In the month of June, Good Hope sold $40,000 worth of goods that only cost them $15,000 to make. That is a fantastic gross profit of $25,000. If you just looked at that number, you'd think they were rolling in money, right?
But here's the reality check. Good Hope allowed their customers to buy on credit. In fact, only 50% of those sales were paid in cash. So they only received $20,000 in cash inflows, but they still had to pay $15,000 in cash outflows for the materials. That leaves them with an actual cash surplus of just $5,000. So despite a $25,000 profit, their actual bank account only grew by $5,000. Put it this way, if they had a surprise $10,000 tax bill due that week, they'd be completely insolvent. Game over.
Moving to Section 2, Anatomy of Cash Flow. Let's look at the cash flow cycle.
Let's trace how money actually moves through a business over time. Stage 1, you hold the cash. Stage 2, you spend it on materials, wages, and rent. Stage 3, time passes as you manufacture the goods. Stage 4, you sell the goods, often on credit. And finally, Stage 5, the customer actually pays and the cash returns to Stage 1. Notice that dangerous time gap between Stage 2 and Stage 5? You're bleeding cash in Stage 2, but you don't see a dime of it back until Stage 5. Managing that gap is the entire game.
Section 3, forecasting the future, or how we go about predicting cash needs.
Because that time gap is so risky, managers basically need a crystal ball, and that's the cash flow forecast. Let's look at January for Good Hope. They start with an opening balance of $10,000. Their inflows are $35,000, outflows $30,000. Simple math gives them a positive net cash flow of $5,000. We add that to the opening balance, and they close out January with a very healthy $15,000.
But let's jump to February. The opening balance is that $15,000 from January. But look at the outflows. They spike to $65,000, way past the $45,000 coming in. This creates a massive negative net cash flow of $20,000. It completely wipes out their $15,000 in cash, leaving them overdrawn by $5,000. Without this forecast, this February plunge would hit them completely by surprise and likely destroy the business. But since they forecasted it, they can actually see that March brings relief. They start March $5,000 in the hole, sure, but a positive net cash flow of $10,000 rescues them, pulling the closing balance back into the black at a positive $5,000. Forecasting these wild swings means a manager can literally walk into the bank in January, arrange a temporary overdraft for February, and prove they can pay it back by March.
On to Section 4, Solving Cash Shortages. Opening up the first aid kit.
So when you do forecast a terrifying drop like Good Hope saw in February, what are your options? Well, the quick fixes all come with some pretty serious limitations. You could grab a bank overdraft, but the high interest eats right into your profits. You could delay paying your suppliers, but surprise, they might get angry and refuse to deliver your essential stock, grinding production to a halt. You could insist your customers pay cash only and kill the credit lines, but they might just take their business to a competitor who gives them more time. Or you could delay buying new equipment, but eventually outdated machinery just kills your efficiency. Bottom line, every quick fix carries a heavy trade-off.
Section 5, Working Capital, the absolute lifeblood for sustaining day-to-day operations. This brings us to the core concept that keeps a business breathing. Working capital equals current assets minus current liabilities. Current assets are short-term items of value that'll turn into cash within a year. Current liabilities are your short-term debts that have to be paid within a year. This formula tells you exactly how much short-term capital you actually have available to keep the lights on, pay your staff, and buy today's materials. Without enough working capital, the business literally suffocates.
Working capital generally takes three main forms: cash, debtors, and inventories. Cash is obviously for your immediate daily expenses. Debtors are the customers who owe you money from credit sales. And inventories are your raw materials and finished goods waiting to be sold. You have to balance these perfectly. If you hoard too much inventory or let too many customers owe you money for too long, you tie up all your value in things you can't spend, draining those life-saving cash reserves.
Final section, Part 6, Case Study on Sunny Days. Let's apply what we've learned. All right, let's put all these pieces together with a real-world scenario from the source text, the Sunny Days ice cream stall. Put your bank manager hat on for a second. Sunny Days starts October with $1,000 in the bank. They've got cash sales mapped out for 3 months, their purchases are consistently 40% of sales, and they've got fixed wages and rent of $1,500 a month. The big event? In November, they want to drop $2,000 in cash on a brand new freezer. So, the million-dollar question is, do they even survive November? Let's do the math. In October, they bring in $4,000, spend $1,600 on purchases, and $1,500 on fixed costs. They clear $900, ending October with $1,900. That becomes their opening balance for November. Now, in November, sales dip to $3,000. They spend $1,200 on purchases, $1,500 on fixed costs, plus an enormous $2,000 on that new freezer. That's $4,700 going out, with only $3,000 coming in. They hemorrhage $1,700 that month. But because they started with $1,900, they carefully squeak by with a closing balance of exactly $200.
Knowing that massive freezer purchase drops their cash reserves down to a dangerously low $200 right before December, would you, as a bank manager, approve a $2,000 loan to Sunny Days to spread out that cost? Or is their cash flow just too tight to risk it? Based on everything we just uncovered about predicting the future and managing the lifeblood of working capital, what's your call? I'm going to leave you to chew on that. Thanks so much for joining me for this explainer.